a federal law called the Real Estate Settlement Procedures Act, commonly known as in the industry as RESPA. Now, the original intent when this law was passed back in 1975 was that it was designed to protect the consumer, so the consumer who was out getting a loan would have a disclosure of the cost associated with borrowing that money. Now, certainly since 1975, this particular law has broadened quite a bit. Now, on your screen, there is one thing that you probably should know for your real estate licensing exam, and that is that there's a federal agency called the Consumer Finance Protection Bureau, or what we like to call the CFPB. That is the federal agency that is tasked with enforcing the Real Estate Settlement Procedures Act rules and regulations. All right, so that's probably something that you need to know for your licensing exam. So the overview, what are we going to learn here today, or what does RESPA entail? Well, it requires certain disclosures of settlement cost, or what we call closing cost. And then there are certain time frames that those closing costs or settlement costs has to be given to the consumer. It prevents kickbacks. It places limits on the amount of the escrow funds or the escrow accounts. It also allows and regulates what we call affiliated business arrangements. It has certain prohibitions in there. For example, it prohibits agents and sellers from requiring buyers to use certain specific title insurance companies. And then it also requires borrowers to receive other certain documentations. All that we're going to talk about in this video, and you have to know it, not only for the real estate licensing exam, but quite honestly, to protect yourself when you become a practitioner in the real estate industry. All right, so the first thing I want to talk about is kickbacks. Now, as it says on your screen, kickbacks, one of the things is it prevents referral fees between real estate service providers. Now, who are real estate service providers? Well, real estate agents is considered a service provider. Home warranties, mortgage companies, mortgage lenders, banks, home inspection companies, termite companies, pretty much any company that could be involved in a real estate transaction under RESPA is considered a service provider or a real estate service provider. So what does that mean? It means that, for example, a real estate agent couldn't go to a loan officer and say, here's the deal. Every buyer that I send you, you cut me a referral fee of $250 or $500. The amount doesn't matter. It's the formation of the business arrangement that's illegal. So that would be considered a kickback. Excuse me, and that would be illegal under the Real Estate Settlement Procedures Act. That is the first thing that the law does. The second thing that the law does is prohibits choice of title insurance companies. So it prohibits a seller or an agent, whether it's the listing agent or the buyer's agent, from using the terms of the transaction to require a buyer to purchase title insurance from a specific company. Now, for the purposes of the exam, that's really all you need to know. All right, I'm not going to get into what's the difference between an escrow closing company and an insurance company, a title insurance company, because there is a difference. But what you need to know for the licensing exam is it prohibits sellers and agents from requiring the buyer to purchase title insurance from a specific insurance company. So just keep that in mind. You'll learn more about that as you get into the industry. Number 3, it limits the amount of escrow accounts. And this is important. This is an important concept. So we have to understand what the PITI is. PITI stands for principal, interest, taxes, and insurance. So when you go to the bank and borrow money for a house, you're going to have a monthly mortgage payment. Well, that mortgage payment is divided into 4 categories. It's divided into the principal and interest, and that's the amount that you have to pay the bank back for borrowing the money. So you're paying the bank back the money that you borrowed. But there is the taxes and insurance part, and that allows the bank to pay on your behalf the annual homeowner's insurance and then the annual property taxes. And in many jurisdictions, the principal and interest can be just as much as the taxes and insurance. Well, the taxes and insurance, that is sent to an escrow account at the bank, or the bank may have a subsidiary company to take care of this. But it's that TI, the taxes and the insurance portion of your monthly payment, that gets sent to this escrow account. So the money is there. So every year the bank then pays or the escrow account will then release funds to pay for your homeowner's insurance and your property taxes. That is what an escrow account is. Now, what was happening prior to RESPA is if a bank or a lender would if they were concerned about the consumer that they were loaning the money to, what they would do is have an exorbitant amount requirement for the escrow account. So if you only needed $1,200 a year for the escrow account to pay your taxes and insurance, legally the bank could require $20,000. And they would simply say that if you don't comply with our requirement, we're not going to give you the loan. So Congress seen this as being egregious and said, no, that's ridiculous. So they placed a limit on how much could be in an escrow account. And it only allows an escrow company to hold up to 1/6 of the amount that's needed, in addition to the amount that's needed to pay the taxes. So they're allowed to have a little overage. But now, as you can see on your screen, if you only needed $1,200 a year to pay your property taxes and your homeowner's insurance, then the most in any given 1 year period that the escrow company could have in your account is $1,400. So they would be allowed to have a $200 cushion there. Anything above that $1,400 threshold, then a refund would have to be given on the 1 year adjustment date. So every year under RESPA, the escrow company is required to review your escrow account and adjust accordingly. Now, typically taxes and insurance go up every year. So what you find is more and more money is needed for the escrow, and therefore your TI part of your payment goes up. However, if for whatever reason it went down and it went above that 1/6 threshold, then they would have to refund the amount above 1/6, and that would be done on an annual basis. So the key here is to refund any amount above 1/6 that's needed in your escrow account. Number 4, RESPA requires the disclosure of settlement cost, or what we call closing costs, to the borrower. Now, a couple of things you have to know. Number 1, the disclosure to the buyer must disclose to the buyer the estimated settlement cost using what's called a loan estimate. That's the document. It's called a loan estimate. And that estimate must be given, or that document, the loan estimate, must be given to the borrower within 3 business days of making application for the loan. So that disclosure is going to have a printout of all the estimated closing costs for that loan. All right. And that has to be given to the borrower within 3 business days of making application. That's important to remember. The borrower must also be given a Consumer Finance Protection Bureau closing cost booklet. And then the borrower must receive a closing disclosure. That's a separate document 3 days prior to the settlement closing or the closing date. So we have 2 documents. The borrower goes in and makes application. Within 3 business days of making application, the borrower must receive from the lender within 3 business days a document called the loan estimate. It's going to have an estimated or a printout of all the estimated costs associated with that loan. Then 3 days prior to closing, then they're going to get a closing disclosure. It's a separate document that basically does the same thing. So therefore, it allows the borrower to make a comparison. What was the initial estimate? What was the final estimate? And if it's really egregious, and there's some thresholds that are built in, we're not going to discuss those, the borrower does not have to go through with closing. All right. right. So number 5, loan types. It's probably important too that you know under the Real Estate Settlement Procedures Act, the types of loans that apply are the 1 to 4 family residence, which is the single family house, the duplex, the threeplex, and the fourplex. It can apply to investment properties as well. Here is the key, and you have to know this for your real estate exam. It applies to all federally related loans. Now, federally related loans can be veterans loans or VA loans. It can be Federal Housing Administration loans, which we typically call FHA loans. It can be conventional loans. You don't really have to know that so much for the exam. You have to know that RESPA, or the Real Estate Settlement Procedures Act, applies to all federally related loans. That's an important thing you need to know. And there are a couple of exceptions. Number 1 is seller financing. So if you're doing a land contract, you're not going to have any of these disclosures. And understand that under federal regulation, an investor, for example, is only allowed to do 2 or sell 2 properties on land contract in a 1-year period, or every year. So they're allowed 2 per year. If they do 3 or more, then they actually have to get a mortgage origination license. And then loan assumptions. They don't have to that, because remember, on a loan assumption, you're simply changing the names to the loan. None of the terms of the original loan is going to change. Well, the 6th and final thing I want to talk about is RESPA, or the Real Estate Settlement Procedures Act, allows and regulates what's called affiliated business arrangements. And they're very common in the practice of real estate. And basically what it is we have the broker, and then we have all of these real estate service providers like home inspectors, lenders, we have home warranty companies, termite inspectors, those type of things. Now we know under RESPA, because we talked about it, that there can't be kickbacks from referral fees. That's illegal. But what happens if a broker and a lender get together and they create a legitimate business arrangement? How does the broker get paid from that? So the broker is going to encourage their agents to refer this mortgage company to the buyers that come through the real estate company. And of course, we know the disclosures and stuff have to be made, but how does that work? Well, here's how it's regulated. Number 1, the agent or the broker must disclose in writing the arrangements, these business arrangements that the agent or the broker is offering their buyer. So if an agent at 12th Street Realty is referring their buyers to A1 Mortgage Company, and the broker of the real estate company and the owner of the mortgage company have a business arrangement or a business agreement, then a disclosure must be given to the buyer. It has to be in writing. It's called an affiliated business arrangement. That's what it's called. It's an actual document. It has to be in writing. Now, in addition to the disclosure, the other thing that disclosure must include is estimated cost to use that company. So not only is the agent making the disclosure in writing to the buyer about A1 Mortgage Company, on that disclosure is going to be the estimated cost if you use A1 Mortgage. Now, understand this applies to any other real estate service provider. So if the broker had an arrangement with a lender and a home inspection company, the same rules would apply. The other thing that can happen, number 4, is the agent or the broker can't require their agent to require the buyer to use those affiliated service providers. Now, they can encourage their buyers to use them. They can say that, they can say they're a great company, those type of things. But what they can't use is the terms of the transaction to require the buyer to use any one or all of those affiliated companies. Number 5, brokers and agents can't receive referral fees. We talked about that, but the one thing that they can do is they can receive compensation from legitimate business arrangements. So let's finish this up by describing how this works. You have 12th Street Realty and you have A1 Mortgage Company. The owners of the two companies come into a business arrangement. Maybe they create a limited liability company or whatever. Point is the mortgage company is going to receive profits. They are a for-profit company. And through the normal course of distributing dividends or passing through profits to the owners, the broker can benefit in that regard. What they can't do is receive referral fees from the transactions, only receive compensation through the distribution of dividends or profits via the company. The other way that this happens is many brokers, instead of entering to a business relationship together, the broker will enter into a marketing agreement with the lender or with the home warranty company or the home inspection company. And it'll be so much every month. A marketing fee is what they call it. We call it a controlled marketing arrangement. And those are perfectly legal as long as the amount that's being charged to those real estate service providers are fair market value. What you couldn't do is the loan company couldn't say, well, I'm going to rent an office at the real estate company, so I have an in-house mortgage company there, when the real market value or the real rent value on the open market for that office is $300 a month, but the loan company pays them $3,000 a month. That would be a violation of RESPA. So the only amount that the real estate broker could charge for rent for that in-house office in the real estate firm would be $300 a month, because that's the fair market rental rate for where that office is located. The same thing with marketing. You know, how much, and this is the hard part, it's hard to value this. I have your, if you put the lender's logo on the real estate company's website, how much is that worth? I don't want to go down that road because it's a very complex formula. However, many individual agents have the same kind of arrangements with the brokers who own real estate firms. So this does apply to brokers and agents alike. Key things to come away with when we're talking about number 6, affiliated business arrangements: disclosures have to be made and no referral fees. And then any compensation that is given has to be of fair market value. So that one's a long, complicated part of this entire video, but you have to know it. So, all right, that is all for the Real Estate Settlement Procedures Act. If you're going to continue to study, check out this video. It's going to help you. And do me a favor, if you have not subscribed to our channel, click on the little circle. I would appreciate that. I'll see you in the next video.